Hello! Welcome to Capital Sensei. Here, our goal is to untangle the often confusing world of money and economics, making it accessible for everyone. Whenever we can, we try to answer questions left in the comments. So please, feel free to share your own stories, your doubts, and your financial journey below. Your experience can help someone else, and together we can build a community that learns and grows. Today, we're gonna dive deep into one of the most important finance books of the last decade, The Psychology of Money by Morgan Housel. We'll explore why your personal history shapes your financial decisions more than any spreadsheet, the critical difference between being rich and being wealthy, and why your behavior with money is far more important than how much you know. We'll talk about luck, risk, and the strange paradox of why we buy things to impress people who frankly aren't paying attention to us. Let's start with a foundational idea from the book that might bring you some relief. No one is crazy. People from different generations and backgrounds do wildly different things with their money. And it's not because one group is smarter than the other. It's because everyone's view of the world is shaped by their own unique experiences. If you grew up during the Great Depression, you might see hiding cash under the mattress as the most sensible thing in the world. If you grew up during the tech boom of the 1990s, you might see stocks as a one-way ticket to prosperity. Your personal experience with money represents maybe 0.00001% of what's happened in the world, but it accounts for maybe 80% of how you think the world works. So when you see someone making a financial decision that seems insane to you, remember, they're not crazy. They're just playing a different game, one that's been shaped by a lifetime of lessons you never had. This empathy is the starting point for understanding finance, because it begins with understanding people. Now, let's talk about two forces that control so much of our financial outcomes: luck and risk. They are two sides of the same coin. We have a tendency to view our own successes as the result of skill and hard work, while we see our failures as the result of bad luck. But when we look at others, we often attribute their failures to bad decisions and their successes to good luck. The reality is, both play a massive role for everyone. Housel tells the story of Bill Gates. Yes, he was brilliant and driven, but he also happened to go to one of the only high schools in the world at that time that had a computer. That was an extreme stroke of luck. At the same time, his school friend Kent Evans, who was equally brilliant and shared that early passion for computing, died in a mountaineering accident before he could graduate. That was an extreme stroke of risk. The lesson isn't to downplay hard work, but to develop a humility that acknowledges the role of randomness. You can't control luck, but you can position yourself to survive risk. This brings us to one of the most dangerous traps in modern life: the problem of never enough. Imagine a young investor who dreams of making his first $1 million. He works hard, saves diligently, and one day he hits his goal. Is he happy? For a moment, maybe. But then he looks around and sees his peers, some of whom now have $2 million. Suddenly, his $1 million doesn't feel like an accomplishment. It feels like a new starting line. The goalposts have moved. This is the poison of social comparison. There will always be someone with a bigger house, a faster car, or a larger portfolio. If you tie your sense of satisfaction to being ahead of others, you are running a race with no finish line. Housel uses the tragic example of Rajat Gupta, a man who went from being a respected CEO to a convicted felon for insider trading. He already had a net worth of $100 million, but he desperately wanted to be a billionaire like the people in his social circle. That desire for more destroyed him. Let's dig into a related idea Housel calls the man in the car paradox. When you see someone driving a flashy Ferrari, what do you think? Do you think, wow, the person driving that car must be so cool, successful, and admirable? Probably not. Instead, you're more likely to think, wow, if I had that car, people would think I'm cool and successful. See the paradox? We use wealth as a yardstick to get admiration from others. But when we see others with wealth, we don't admire them. We just use their possessions as a benchmark for our own desires. People want wealth to signal to others that they should be liked and admired. But what people truly crave isn't the fancy watch or the expensive suit. It's the respect and admiration they think those things will bring. The irony is that humility, kindness, and empathy will bring you far more respect than any sports car ever will. Understanding this can save you a fortune because you'll stop spending money on things to get a reaction that never really comes. So, if buying flashy things isn't the answer, what is? This leads us to one of the book's most critical distinctions: the difference between being rich and being wealthy. Being rich is about your current income. It's visible. The person earning $500,000 a year who spends $499,000 on a big house, luxury cars, and 5-star vacations is rich. You see their lifestyle, and it's impressive. Wealth, on the other hand, is hidden. Wealth is the income you don't spend. It's the money that's been saved and invested. It's the stocks, bonds, and real estate in your portfolio that are quietly compounding, giving you options, flexibility, and control over your own time. Wealth is what you don't see. It's the car that wasn't bought, the diamond that wasn't worn, the first-class upgrade that was declined. We can't see wealth, so we have a hard time learning from wealthy people because their success is often invisible. This leads to a simple but profound truth. Building wealth has less to do with your income or investment returns and more to do with your savings rate. A person who earns $50,000 a year but saves $20,000 of it is on a better path to wealth than a person who earns $150,000 but only manages to save $10,000. Your savings rate is more in your control than anything else, more than market returns, more than your salary increases. It's the gap between your ego and your income. Now, let's talk about the engine that turns savings into true wealth: compounding. I know, you've probably heard this term before, but Housel frames it in a way that really hits home. We often think of compounding in terms of math, but it's really about time. The human brain isn't wired to intuitively grasp the power of exponential growth. We think in linear terms, but good investing isn't about earning the highest returns. It's about earning pretty good returns that you can stick with for the longest possible period of time. Let's look at Warren Buffett. He is a phenomenal investor, but his real secret is time. His net worth is often cited as being over $100 billion. But a staggering 99% of that wealth was earned after his 50th birthday. In fact, more than $81.5 billion of his $84.5 billion net worth came after his 65th birthday. His skill is investing, but his secret is time. He started investing at age 10 and has never stopped. Imagine if Buffett had started investing in his 30s and retired in his 60s like a normal person. He'd still be a multimillionaire, but nobody would have ever heard of him. The takeaway isn't that we all need to be the next Warren Buffett. It's that we need to appreciate that wealth isn't built overnight. It's the result of steady contributions and letting the snowball of compounding roll down a very, very long hill. The real work happens when you're not looking. This naturally leads to a fork in the road. There's getting wealthy, And then there's staying wealthy. And they are two completely different skills. Getting wealthy often requires taking risks, being optimistic, and putting yourself out there. It's about being bold. But staying wealthy is almost the opposite. It requires humility, fear, and an awareness that what you've gained can be taken away just as quickly. It's about survival. Think of it like this. Getting wealthy is offense. Staying wealthy is defense. A good offense gets you on the scoreboard, but a good defense wins the championship. The world is full of stories of people who were brilliant at getting rich, but terrible at staying rich. Athletes, lottery winners, even great investors. They confused their initial risk-taking success with an invincible skill and kept making bigger and bigger bets until they inevitably lost it all. The key to staying wealthy is a survival mindset. It's about avoiding ruin at all costs. And how do you avoid ruin? By understanding another key concept. Tails, you win. In many areas of life, if you're right 51% of the time, you're a genius. In investing, it's different. You can be wrong most of the time and still end up fantastically wealthy. This is because of the power of long tails, where a few events account for the majority of the outcomes. Think of it like a venture capital firm. They might invest in 100 startups. 90 of them will fail, losing all their money. 9 of them might do okay, maybe breaking even. But one of them becomes the next Google or Amazon, and its returns pay for all the other failures and then some. The same is true for a regular person's stock portfolio. Over your lifetime, the bulk of your returns will likely come from just a handful of your best investments. The other stocks might go up, down, or nowhere at all. The important thing isn't to pick every winner. It's to build a diversified portfolio that gives you exposure to the potential tail-end winners and to have the endurance to stick around long enough for them to work their magic. It's okay to have a portfolio full of losers and a few spectacular winners. That's usually how it works. So, we have these big concepts: compounding, saving, survival. But what is it all for? What is the ultimate goal of having money? Is it to buy more stuff? Housel argues that the highest form of wealth, the ultimate dividend that money pays, is the ability to control your own time. It's the freedom to wake up every morning and say, I can do whatever I want today. Having a stash of savings means you can take a lower-paying job with a shorter commute that you actually enjoy. It means you can afford to take time off when your kid is sick without worrying about your next paycheck. It means you can retire when you want to, not when you have to. It means you can weather an unexpected medical bill or a job loss without it turning into a life-shattering catastrophe. This control over your time is a form of wealth that can't be easily measured, but its value is immense. This connects to a simple yet powerful idea: save money just for the sake of saving. We're often taught to save for a specific goal: a down payment on a house, a new car, a vacation. Those are all fine. But Housel argues that one of the best reasons to save is for the unexpected, for the opportunities and emergencies you can't possibly foresee. Building a buffer of unallocated savings gives you options. It's a hedge against the inevitable surprises that life will throw at you. Now, let's get into the nitty-gritty of how to behave as an investor. One of the most freeing ideas in the book is that it's better to be reasonable than to be coldly rational. What does that mean? A rational approach, something an economist would design on a spreadsheet, might say you should put every single spare penny into the highest returning asset class and never touch it. But that approach might be so stressful and volatile that you can't emotionally handle it. You might panic during a market crash and sell everything at the bottom. A reasonable approach, on the other hand, acknowledges that you are a human being with emotions. A reasonable strategy might be to have a slightly more conservative mix of stocks and bonds, one that lets you sleep at night. It might not produce the absolute maximum theoretical return, but if it's a strategy you can stick with for decades, through thick and thin, it will ultimately be more successful than the perfect strategy you abandon after 6 months. Think of it like a diet. The best diet isn't the one that promises the fastest results. It's the one you can actually stick with. This is especially important because the future is guaranteed to surprise us. Housel emphasizes that history is a good guide to the generalities of how markets work. They tend to go up over the long term. They experience cycles of boom and bust, but it's a terrible guide for the specifics. The next crisis will not look like the last one. The world is constantly evolving. The 1933 banking crisis was different from the 1987 crash, which was different from the 2000 dot-com bubble, which was different from the 2008 financial crisis, which was different from the 2020 pandemic. Relying too heavily on past data to predict the future is like driving a car by looking only in the rearview mirror. It tells you where you've been, but not what's around the next corner. Since we can't predict the future, the only logical response is to prepare for a wide range of outcomes. And the way you do that is by leaving room for error. This concept, also known as a margin of safety, is arguably the most important takeaway for any investor. It's the gap between what you think will happen and what could happen. When an engineer designs a bridge, they don't build it to withstand the exact weight of the average traffic. They build it to withstand a weight that is 3 or 4 times greater. That's their room for error. It protects them from unknown stresses, freak events, and simple miscalculations. In your financial life, room for error means having a healthy emergency fund. It means not being 100% invested in volatile stocks. It means not taking on so much debt that a small drop in your income could lead to default. It means having a buffer. This buffer is what allows you to endure the surprises and stay in the game long enough for compounding to do its work. Without a margin of safety, you are fragile. With it, you are robust. Another reason you need flexibility is that you will change. The person you are today is not the same person you will be in 10 or 20 years. Your goals, your values, your desires will evolve. The hardcore career path you crave at age 25 might seem like a prison to your 45-year-old self, who just wants to spend more time with family. Committing to an extreme, decades-long financial plan is dangerous because you're essentially making a bet on who you'll be in the future. This is the fallacy of long-term planning. It's good to have a general direction, but you need to avoid the kind of rigid plan that doesn't allow for life to happen. The best plans have room for error, not just in the market, but in your own life. They allow you to change your mind without starting over from scratch. Sunk costs, the time and money we've already spent, often trap us in paths we no longer want to be on. Accepting that you will change is a form of financial wisdom. Let's talk about a feeling every investor experiences: the sting of a market downturn. It feels like a punishment, like a fine for doing something wrong. Housel offers a brilliant reframing of this. Nothing's free. The volatility and occasional losses in the stock market are not a fine. They are the fee. It's the price of admission you have to pay to earn the long-term returns that are higher than cash or bonds. Think of it like buying a ticket to Disneyland. You pay the fee at the gate, and in return, you get to enjoy the rides. You wouldn't demand a refund just because it rained for an hour in the afternoon. That's just part of the experience. Similarly, Market downturns are the price of admission for long-term growth. If you try to avoid the fee by jumping in and out of the market, you'll likely miss the rewards too. Once you see volatility as a fee instead of a fine, it becomes much easier to stomach. Now, let's address a subtle but powerful danger: taking financial cues from the wrong people. Housel calls this the you and me problem. It's crucial to understand that not everyone in the market is playing the same game you are. A teenage day trader using a mobile app is playing a completely different game than a 60-year-old nearing retirement. The day trader's time frame is minutes or hours. The retiree's time frame is decades. The day trader might be betting on short-term momentum, while the retiree is focused on long-term dividends and capital preservation. If the retiree sees the day trader making a quick profit on a hot new stock and decides to copy that strategy, it could be disastrous. The bubbles and manias we see in markets are often caused by short-term traders luring in long-term investors who don't understand the game they're playing. Before you take a financial tip from anyone, ask yourself, what is their time frame and what are their goals? Are they playing the same game as me? This leads us to another psychological bias: the seduction of pessimism. For some reason, pessimism just sounds smarter and more plausible than optimism. When someone predicts a market crash, we see them as a sharp, critical thinker. When someone predicts a bright future, we often dismiss them as a naive salesperson. Progress happens too slowly to notice, but setbacks happen too quickly to ignore. A single plane crash makes the news. The millions of safe flights that day do not. This bias has a huge impact on how we invest. Pessimistic stories are everywhere, and they are compelling, but they are often wrong. While the world faces constant challenges and markets experience brutal downturns, the long-term trend for humanity and for well-diversified economies has been one of growth and progress. Optimism, the belief that the odds are in your favor over the long run, is the correct stance for a long-term investor. Pessimism grabs headlines, but optimism builds wealth. Finally, Housel leaves us with a warning about the power of stories. He calls it the "when you'll believe anything" problem. We are narrative creatures. We want the world to make sense, so we create stories to explain complex events. The more we want a story to be true, the more likely we are to believe it, even in the face of contradictory evidence. This is especially true with money. We want to believe there's a secret formula, a hot stock tip, a way to get rich quick without risk. These appealing fictions are powerful because they offer us a sense of control and hope in a world that is inherently uncertain. The reality of successful investing is frankly pretty boring. It's about saving a decent portion of your income, diversifying, being patient, and letting compounding do the heavy lifting over many, many years. That's not a very exciting story, but it's the one that actually works. So, when we pull all these threads together, what is the psychology of money? It's the understanding that finance is not a hard science like physics. It's a soft skill where how you behave is more important than what you know. It's about recognizing your own biases, the danger of comparison, and the role of luck. It's about knowing the difference between what's visible, being rich, and what truly matters, being wealthy, which is having freedom and control. Perhaps the single most powerful financial skill is getting the goalposts to stop moving. It's not about constantly striving for more. It's about defining what enough means to you. Once you have that, you can step off the hamster wheel of social comparison and start using money for what it's really for: living a better life, more autonomous life. And that, more than any stock market return, is the true prize.